More and more fund managers are now receiving requests from clients to de-China their investment portfolios to reduce geopolitical risk. Political pressure on Western government funds investing in China has been mounting for the past 5 years, and the poor performance of China's stock market in recent years, particularly in 2024, has accelerated the exit of foreign capital. Over the years, the enthusiasm that American investors once had for China has fueled the growth of several private equity funds that specialize in China investments. As of 2019, these funds attracted as much as $140 billion in capital, much of it from individuals and pension funds. By 2021, that figure shrank to $93 billion, and in the first 10 months of 2023, those inflows shrank to $4 billion. Now, the world's largest funds, including the American ones, have begun to quietly withdraw from the risky China market, including by removing as much as $68 billion of international funds invested in the Hong Kong market. Some overseas sovereign funds that were entrenched in the Chinese market have chosen to leave. For example, at the end of September 2023, the world's largest sovereign fund, the Norwegian Sovereign Wealth Fund, announced the closure of its Shanghai office and the relocation of its Asian operations center to Singapore. The Shanghai office was in operation for nearly 16 years, and by the end of 2022 had invested in about 850 Chinese companies with a total value of about $42 billion. Including internet powerhouses such as Alibaba, Tencent Holdings, Meituan, Jingdong, and Pinduoduo. 3 Canadian pension funds announced their exit from China in 2023 and suspended their private equity investments in China. Now it's the US's turn. After analyzing the position reports of 14 U.S. pension funds with more than $500 million in assets invested in Chinese shares, Bloomberg found that most of the pension funds have reduced their holdings of Chinese stocks since 2020. Among them, one of the largest pension investors in the U.S., California Public Employees Retirement System, and the New York State Common Retirement Fund have cut back their investments in the Chinese market for the 3rd consecutive year. Certain funds are dropping out of the Chinese market entirely. In December 2023, the Missouri State Employees Retirement System asked its staff to withdraw all current global public equity investments in China. The report said that the withdrawal of these funds was initially a matter of performance, but it's likely to evolve into a structural shift as a result of increased skepticism about China's long-term economic problems, the fragility of its real estate market, and worsening strategic rivalry between the US and China, to name but a few factors. Some large pension fund managers in the US and Australia have also expressed caution about China because of increasing geopolitical risks and the sluggish recovery of its economy since the epidemic. There is growing demand from global investors for funds to exclude China. Gary Duggan, Chief Investment Officer at Dalma Capital Management Limited, told Bloomberg that it would re-benchmark the Morgan Stanley Capital International MSCI Index excluding China. He said, "Foreign investors will no longer have to worry about excluding China from their investment area." Chris Ailman, Chief Investment Officer of the California State Teachers Retirement System, said in an interview that China is a recurring topic of discussion among U.S. and global Chief Information Officers. He said, "Some firms have cut their index weightings in half to reduce exposure, and others have removed China from their emerging market indexes." Hong Kong has always had an open and market-driven economic tradition. However, with the increasing integration with the CCP in trade, tourism, and financial relations, and the deprivation of various freedoms, Hong Kong's top position as a free economy has fallen. Hong Kong's politics, economy, and culture are all on the decline. Surely, the officials of the Hong Kong government are behaving like the Premier of China. The Chinese economy is making steady progress and will continue to provide strong impetus for the world economic development. China is an important engine of global development. In recent years, our contribution rate to world economic growth has been around 30%. In the past year of 2023, China's economy has recovered overall and is improving. Our expected GDP growth rate is around 5.2%, which is higher than the target of around 5% set at the beginning of last year.
确定的5%左右的目标。
Officials in Hong Kong have actively cooperated with the Beijing government's initiative of singing the bright theory of the economy. The 17th Asian Financial Forum, AFF, was held between January 24th and 25th in Hong Kong, with a focus on the potential of the Chinese mainland market and the role and advantages that Hong Kong can play. During the opening ceremony, John Lee, chief executive of the Hong Kong Special Administrative Region, said in his speech that one country, two systems brings far-reaching opportunities to Hong Kong, enabling its financial sector to thrive despite challenges. He said Hong Kong has long been a major listing platform for companies worldwide, while serving as a preeminent biotech fundraising hub. Lee said mutual market access between Hong Kong and the mainland, from stocks to bonds and derivatives, continues to expand, firmly establishing Hong Kong's indispensable role as the capital bridge between the mainland and international financial markets. According to Chinese official media, it attracted over 3,000 finance and business elites from across the world. However, managers of U.S. federal pension funds aren't optimistic about Hong Kong stocks nowadays. This is because the Hong Kong stock market has been shrinking in recent years, and its development has come to a standstill. On November 14, 2023, the U.S. Federal Retirement Thrift Investment Board, FRTIB, a $770.5 billion fund, said that in response to increasing geopolitical risks, it had decided to make changes to its thrift savings plan after a routine review. It decided to change the benchmark of its International Stock Index Investment Fund, or iFund, in response to increasing geopolitical risks. In other words, in addition to mainland China, FRTIB will also exclude investments in the Hong Kong market from its $68 billion international fund, meaning it will no longer include an index of Hong Kong-listed stocks. FRTIB's decision was made on the advice of its investment advisor, Aon Corporation, one of the world's professional services and management consulting firms, and FRTIB staff. The report said Washington's increased investment restrictions on China were the main reason for its decision. FRTIB, which manages retirement savings accounts for nearly 6.9 million people, said the iFund will shift from the MSCI Europe, Australia, and Far East indexes to the MSCI Global Investable World Markets Index, excluding the US, China, and Hong Kong. The change will more than double the number of countries included in the iFund. The international reduction of investment in China will have a huge impact on Hong Kong. The City of London Corporation announced the 2024 ranking of global financial centers. This year, Tokyo caught up with Hong Kong and tied for 6th place. London ranks first, followed by New York, Singapore, Frankfurt, and Paris. This is the second time Hong Kong has slipped in international financial rankings. In 2020, Hong Kong lost the top spot in the Economic Freedom Index set by the Heritage Foundation for the first time, having topped the list for 25 consecutive years. At present, there is no way out for the Hong Kong economy. Hong Kong government officials are attempting to rely on the mainland Chinese market. But what can they rely on when the Chinese economy is struggling itself? Morgan Stanley says European fund managers are in line with their U.S. counterparts in that they are playing catch-up in adjusting their holdings in China. Reuters reported that Morgan Stanley analysts said earlier this year in January that global long funds sold Chinese stocks at the fastest pace in December 2023 to meet redemption requests and stay away from the world's second-largest economy. In a report released to clients on January 2, 2024, Morgan Stanley's quantitative research team said that in December 2023, China and Hong Kong stock markets saw combined net outflows of $3.8 billion from active global short-buying, long-trading fund managers, with $2 billion of that amount caused by investor redemptions from the funds, with the remainder driven by fund managers rebalancing overseas portfolios. The report said it was the worst month in 2023 and the third largest monthly outflow on record. Among the top sellers were Jingdong, AIA, and Yum China. Analysts at Morgan Stanley, led by Gilbert Wong, said investors redeeming from equity funds and portfolio managers rebalancing their portfolios to further deepen their cuts in China are contributing to the outflows. The report said that dragged down by geopolitical risks, sluggish economic recovery, and uncertainty about CCP's policies, mainland China's stock market and Hong Kong stock market ended 2023 as the worst performers among the world's major indexes. American investors are worried that a large and growing number of doubtful debts will bring huge risks to China's finance, including the debt risks of Chinese real estate developers and the heavy debts of local governments. Investors are also wary of the overall slowdown in China's economy and the failure of infrastructure spending to yield results, all of which raise questions about fundamental problems with the Chinese economy. Also, the Chinese government's obsession with national security has made the data collection necessary for investment almost impossible. Our observation is that over the past many years, the CCP and Wall Street capital have used each other and made huge profits in China. Wall Street capital made short-term profits in China's distorted market and only curbed its enthusiasm for investing in China when China's economy fell off a cliff and A-shares were in dismal condition. The current trend is actually an afterthought. As early as 2018, even when former U.S. President Donald Trump imposed punitive tariffs on Chinese goods, U.S. investors purchased a net increase of $17 billion in Chinese stocks and bonds. In 2020, when the COVID-19 epidemic broke out, the net inflow still rose to $36 billion. And in 2021, the net inflow was almost more than $20 billion. However, by 2022, net portfolio inflows almost stopped. By October 2023, the net outflow was about $31 billion. In other words, Wall Street came to its senses only after it tasted the iron fist of the CCP, realizing that they can invest in China through the lens of a Western market economy. With the withdrawal of U.S. Wall Street capital coupled with the aging population and depleting resources, China's economy is losing its vitality. Hard times are ahead for the people. In early February, as the Chinese New Year approached, crowds of wage collectors and protesters are seen all over China. The game is basically over for foreign investors in China, and mainland Chinese stockholders are in near despair. There are 220 million retail investors in China, accounting for about 60% of the stock market turnover. China's benchmark blue-chip CSI 300 index fell 11% in 2023, while Hong Kong's Hang Seng index, which covers a wide range of Chinese stocks, fell as much as 14%. Marking the fourth consecutive year of decline since it was launched in 1969. In January 2024, the CSI 300 index fell to its lowest level since February 2019, after a record third consecutive year of losses in 2023. On January 22nd, Hong Kong and Shanghai stocks tumbled, with the Shanghai Stock Index posting its worst day since April 2022. International investors are leaving the country that was an indispensable part of their global portfolios just a year ago. On January 23, 2024, Premier Li Chang presided over a State Council Standing Committee meeting. It was reported that policymakers may raise about $278 billion for an equity stabilization fund, but mainland Chinese investors responded with little interest. The next day, the Shanghai Index closed at 2,770.98, falling below the psychological threshold of 2,800 points. The fact that the CCP sought to mobilize $278 billion to bail out the market is a clear indication of the CCP's sense of urgency to keep the faltering stock market afloat. What is the reaction of shareholders? In recent years, the CCP has made the U.S. its number one enemy. But for Chinese stockholders, the CCP is the real enemy. Then, the enemy of the enemy is one's friend. On the evening of January 22, 2024, at the A-share market, the stockholders expressed themselves by saying, U.S. stocks will surely win, on the pop-up screens. And after the word U.S. stocks was censored, they changed it to beautiful will surely win. In Chinese pronunciation, U.S. has a connotation of beautiful country. There are also anxious shareholders calling the China Securities Regulatory Commission, yelling, "If you can't make China's stock market work, just shut it down." Hello, now please speak.
请问是中国
Is
证监
this
会
the
吗？
China Securities Regulatory Commission? You, please speak.
我想问一下这个
I would like to ask if there is anyone in charge of this stock market. It's falling every day and plummeting every day. Foreign stock markets have reached new heights. China's stock market is like a piece of garbage, shrinking every day. The shareholders' money, national wealth are hollowed out. If there is no one to take care of the situation, China's stock market should be closed. Is there anyone in charge of the stock market? I understand what you mean. Are you suggesting that the SFC should shut down the stock market?
我现在有几天建议
I have a
要么
few
就把它做好，
suggestions
要么
now.
就把它
Either
关闭
do a
了。
good job with the stock market, or if you can't do good, just close it down. You have embarrassed us to no end. Our wealth is shrinking like this. There are two main places in China where capital is absorbed, the real estate market and the stock market. Now the real estate market is shrinking. As a barometer of a country's economy, the stock market is highly correlated with changes in the macroeconomy. And to a certain extent, it's even a leading index of a country's prospects. As we can see, after 30 years of development, China's stock market has made it clear to the public that there is no fairness or justice here. Stockholders call China's stock market a policy market, meaning that the market can be turned upside down by a single policy, and thus it's widely regarded by the investment community as a policy market. It's also known as the money market. That is, the stock market is the place where the powerful and interest groups of the CCP come to cut the chives. This highlights the fact that the barometer of China's economy has become dysfunctional. In stark contrast, capital inflows to Taiwan, South Korea, and India are holding up well. South Korea, Taiwan, and India have recorded total inflows of more than US $750 billion. Meanwhile, foreign investors continued to sell Chinese stocks through the Shanghai Shenzhen Hong Kong Stock Connect. It's a trading and settlement interconnection mechanism established to enable direct trading in Hong Kong and China. This action by foreign investors reflects the strong investment in markets outside of China.